The following presentation by Monument Capital Management LLC is intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Please see additional information disclosure at the end of this presentation. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.monumentwealthmanagement.com.
We're asking why gold is outperforming stocks. I would kind of tilt that on its head and ask, why does it matter? I mean, gold is outperforming, and there's an old adage that says that prices move first and news explains later. So does it really matter why gold's outperforming? Just the reality is that it does outperform.
Okay, everybody, welcome back to this quarterly episode of Off the Wall. As hopefully you know, I'm Dave Armstrong, your host, and today's episode is being recorded on Wednesday, October 1st, 2025. Today, I'm here with our asset management team, Erin Hay and Nate Tonsager, for a special public edition of our mailbag, also known as Ask Monument Anything, where we're here to answer smart questions investors are asking us right now. So here's what we plan to do. We want to address the questions in three parts. And those three parts are, we're going to tell you what we know. Okay. And then address why it matters to you. And then what, if anything, you can or should be doing about it. Now, today, since it's the first day of the fourth quarter, I'm just going to do a real quick quarterly recap of the markets from a high levels just to set some context. And then we're going to jump right into answering the three questions. Okay. So, however, before we get to the review and our first question, I just want to let everybody know that we do an Ask Monument Anything like this with our asset management team, but it's actually every month. So you may be asking yourself, why don't I get those monthly videos like I get this one? Well, it's because we publish it on our private insight playlist on YouTube. Okay. So now you're naturally asking yourself, how do I get that? Well, we have the answers for you. If you want to get access to the private non-public episodes that come out monthly, you got to make sure you're subscribed. And you do that by going to monumentwealthmanagement.com/subscribe. And if you can't write that down because you're driving or something, just go to our website. It's on there how to subscribe. And subscribing is what gets you on our newsletter list. And the newsletter list is how we send you the private episode links each month. So there's your hack for the quarter. Get on there, get subscribed, and you'll get something like this, but you'll also get it every month. So with that, let's get to it. Real quick, the S&P 500, I'm going to talk about this on a trailing 12-month total return basis. Okay, so like looking back from today, we're looking back 12 months. And that total return is 15.8%, which is modestly better than what the average is. The average 12-month return going all the way back to 1975 is about 13.2%. So just some context. I find it more useful to think about what has the market been doing for the past 12 months rather than just the quarter. Now, I want to talk about some S&P 500 industries and industry groups real quick. So as you remember, there's 11 S&P industries, right? Like tech, healthcare, those kind of things. And then under each one of those 11 industries are industry groups. And there's a total of 24 industry groups. And I'm going to talk about the 24 industry groups real quick, just to set some context for how well the quarter did last quarter. So of those 24 groups, 90% of them were positive in the third quarter of 2025. That's pretty good. 6 of those 24 industry groups were up over 15%, and 10 of them were double-digit gainers. So pretty good. And my point here is, and why this is important to know, is I personally don't feel like this is something that happens during weak markets. When this many industries are working at once, momentum tends to persist. And the strongest groups they're not fading. They're actually pressing higher with a lot of conviction. For example, the worst performing of the 24 industry groups was healthcare equipment at a minus 3.1%. So this matters because people who are invested and diversified need to stay that way as we head into what's generally considered to be the strongest quarter of the year, which is the fourth quarter. And now that's why it matters. But here's what you should do if you're listening to this right now. But my advice: first, evaluate any overconcentration that you have in your portfolios, because there may be some And when I say evaluate, I'm not telling you to do anything about it. Just evaluate. Just, am I comfortable with this concentration? Yes or no? Answer that question for yourself. If you decide, yes, it is something I should do, trim is necessary and stay invested. However, I will throw out this one cautionary tale. This is not advice for everybody. Everybody needs to look at this through their own personal lens, because one of the things that we do a lot of preaching about here at Monument Wealth Management is making sure that you have cash for the next 12 to 18 months. However, be careful about raising cash right now unless you need it right now. And if you can wait until January to add to your cash position, you're just going to have more time to mitigate any capital gains tax bill that you may have. So you have to look at all of those inputs together and make one decision. Of course, it's true the market could go down over the fourth quarter, and it has in the past. I think about 2018 specifically. But if you can wait until January and you're okay taking that risk of not having the cash available for 3 months, you're going to have 16 months to figure out how you pay that tax bill versus 4 months. So that's just quick piece of what you should be doing right now. So with that context of how well the market did and what some of the industry groups did over the third quarter, I want to jump into our first Ask Monument Anything question, which is this. You might be hearing a lot about private equity and alternative investments right now, especially since the Trump administration signed an executive order in August, which is intended to pave the way for them to be added to retirement plans. Okay, here's the question. What is the purpose of alternative investments in a portfolio? Erin, I'm going to toss that over to you to kind of take it away and give us your initial response there.
I think it's really important before we talk about the purpose of alternative investments in a portfolio to do some defining. So people are going to talk about alternatives, and this is a pretty big umbrella term, but typically alternatives are anything that aren't typical stocks and bonds. And so when we talk about alternatives, as most of the mainstream media covers them these days, I kind of scratch my head a little bit, because often you'll hear of the biggest alternative investments being private equity and private credit. And in my mind, that's just private stocks and private bonds. So I tend to, again, scratch my head to see, and I ask myself, are these truly diversifying investments or not? And that's really the pitch for these alternative investments. It's either some combination of higher returns, lower volatility, or correlation benefits. And on that last piece, going back to correlation benefits, again, I try and break these down, and I think it's a bit more helpful to talk about alternatives into two big buckets. And I would call those buckets as diversifying alternative investments and non-diversifying alternative investments. And that latter bucket, the non-diversifying alternative investments, I would put private credit and private equity in there. And really, that's, again, why they are marketed to go into client portfolios. It's for some combination of higher return, lower volatility, or good correlation benefits. But I think, and taking a bit more of a cynical approach to this, they are being marketed to client portfolios because there's been a Cambrian explosion of privates over the last 20 plus years. And there's got to be some place to put these funds and these products. And we're seeing that now in the form of people lobbying Congress to get quote unquote alternative investments into retirement plans, 401ks, et cetera.
Yeah, I think Erin kind of nailed it, right? Is when we talk about alternatives, that's a vast space. It's a very vast space. But really, I think what the administration, that executive order they signed to pave the way in 401ks, so where are people going to see this more frequently, is on that non-diversified kind of return chasing, I'll put in quotes, with private equity, private credit. I think we hear these stories about, well, this private equity firm 10x'd or grew that investment 10 times over because they were, did such a great job with this company that wasn't public. Well, that might be true, but there's a lot of volatility along the way with those companies. In order to grow something from that rate, it has to start pretty small with a lot of volatility. In private credit, it's the same kind of thing. In private credit, these are funds that are lending to companies that maybe can't get traditional financing. They might earn those higher, returns on that private credit, interest rates of 10, 16, maybe even 20%. But that means a company has to pay it and sustain it. So I think the big theme here is, yes, you can benefit from having private equity, but you got to be able to stick with it for the long term. It's not a real trading vehicle because those prices can go up, they can go down. And if you're not willing to handle some of those swings, that's a lot of volatility, and you are more likely than not to make emotional decisions and not follow the data and really get out and lock in losses for clients. So I don't know if anyone's portfolio really needs 100% private equity. I would say no one really needs that amount of risk. I can see where there's arguments where someone might say, okay, blending it into a stock allocation is beneficial. But again, if you can stick to it for the long term, which is way easier than it sounds, if you ask me.
Yeah, I will close out by saying this, and I'm going to make a little bit of a controversial statement here. But look, everybody thinks private equity, private investments are a good idea, and then they get into them and they figure out what a colossal pain in the ass they are. Okay. And I will give a real life example, and then I'm going to use an analogy for everybody that's listening to this to kind of understand. But I just recently got an email that was forwarded to me from a client who's invested in a private investment outside of us. And they just got the email saying, hey, it's come to our attention that not all the K1s are out yet for this investment. We're hoping to have them out in the next week or so. Well, we're 15 days away from October 15th, which is the tax extension deadline. So this client still doesn't even have all of his tax forms yet to fill out his taxes for 2024. I mean, these things are a massive pain in the ass. And you've got to understand that they sound great when you get into them, but there is a back end, pain that is associated with these kind of investments. And you have to know those things going into it. And you have to ask the right questions before you become an investor. Now, if you're going to become an investor, Josh Brown over at Reynolds Wealth Management wrote an interesting blog recently. We have, and even before his interesting article, by the way, we did an interview with George Coyle on private investments, which is one of our most heavily downloaded episodes that we have. And so go back and make sure you get a listen to that. But we talked about what is the difference between being an investor and being an owner of these private equity funds. And I'm going to break it down like this. I'm going to use a nightclub as an analogy. Now, even if you're not, somebody who goes out and stands in lines to go to a nightclub, you've seen enough on TV to know what I'm talking about. So as a limited partner, there's LPs, limited partners, and GPs, general partners. As the limited partner, you're the investor, right? So here's the analogy. You're a guest at the Velvet Rope waiting to get into this nightclub. And the doorman's, he's selling you on last night's party. He's telling you, oh, it was amazing. And tonight will probably be just as amazing too. And then starts to lay out the rules. Okay, there's a $150 cover charge to get in. Cocktails start at $28 to $30 a piece. There's a 4-drink minimum every single hour. And once you get in, you can't leave the place until the party's over unless you pay some sort of heinous exit fee. And there are absolutely no refunds. Oh, by the way, they won't let you really look inside the club from the velvet line. You don't get to pick the drinks that they bring to your table. And if the place is hopping, they have the right to tack on another 20% on top of the bill every single hour. Okay, so that is your analogy of fee and then performance fee on top of that in the private investment space. Okay, now you decide, okay, I'm going in. You take 2 steps in, you realize the DJ is not your thing. Your friends are texting you that they're not coming or that they're already at some no cover club across the street, which parens is like the public equity markets in this analogy, okay, where they have daily liquidity. And meanwhile, the general partner, who's the owner of the club, okay, well, they get to collect all the cover charges. They get to collect the bar tabs across all the venues that they have, and they get to come and go whenever they want to. So the question that you need to ask and answer for yourself anytime you're talking about private investments is this: do you want to be the guest in the club or do you want to own the club? And if you listen to our podcast, and we'll put the link to that in the show notes, we answer that question for you and give you our thoughts on that below. So that's sort of my tie up, what that means to you and what you should be doing about it. Just make sure you're doing your research on that. So, okay, guys, let's jump into question number 2, which is, this is actually a really good one. Why is gold doing so much better than the stock markets this year? And when I say stock markets this year, I'm like, that is plural in case I didn't enunciate it well enough.
Yeah, I think just to, kick back to those private episodes, last month in that private episode, we talked about why international stocks are doing better than US. Well, gold's doing better than both of them, and significantly. Mm-hmm. I think as the quarter closed out, gold was up somewhere around 45% year to date. that's an insane return. I think it really speaks to gold being what I'm going to call a trendy investment. Trendy meaning when it rallies, it can rally very hard, but it doesn't always rally. I think when you look at it compared to stocks, gold has periods of outperformance and underperformance, just like parts of the market, just like other financial assets. And really to kind of put a number on that, looking back over the past 5 years, 2024, gold outperformed by 1.8%. However, in 2023, underperformed by 13%. In 2022, outperformed by 17%. 2021, underperformed by 32, almost 33%. 2020, during the COVID pandemic, it was outperforming by about 6.4%. So right there, you see over the past 5 years, wild swings of outperformance and underperformance. And that trend continues if you go back 10 years. 2015, 16, 17, gold underperformed, outperformed in 2018, 2019 underperformed. So as you can see, I'm even getting lost by all these numbers about the swings and the trends in the market of it going up, it going down. But when you stretch it out over a 10-year rolling period, so Dave, you kind of mentioned rolling periods earlier, over the past 10 years, gold's lagged the S&P 500 by about 2.6% per year. So even with all those swings, stocks are still doing better over the long term than gold. Now you can stretch that out. Gold goes back decades. The trends move over time. But really, I think when you look at it, gold really rallies in specific market environments. The main one being in high inflation and during when interest rates are falling. Because, as interest rates start to fall, traditional financial assets like the dollar, like bonds that pay interest, while their prices go up, the amount of interest they generate goes down. Gold doesn't generate any interest. So it's seen as a relatively safe haven comparative to those other interest investments when interest rates are coming down. But more importantly, really where does gold get value? Because people think in an apocalyptic scenario where the dollar doesn't exist anymore, you're going to be trading gold nuggets in your backyard. So really, when there's that economic uncertainty or global chaos, gold can really rally. And I think with tariffs, the uncertainty in global markets overall, geopolitical with wars overseas, gold just was really ripe for a rally this strong in 2025.
Yeah, I'll take a slightly different angle on it. Nate, you touched on a couple of these points, but we're asking why gold is outperforming stocks. I would kind of tilt that on its head and ask, why does it matter? I mean, gold is outperforming, and there's an old adage that says that prices move first and news explains later. So does it really matter why gold's outperforming? Just the reality is that it does outperform. But Nate, to your point, you mentioned some environments where gold outperforms. Yes, there's definitely periods where it outperforms and underperforms. I'd say historically, gold performs in low growth environments. Specifically, if you look at the aftermath of the .com crash and look at the 9/11 period, so basically 2000 to 2009, gold was up 280%, while stocks were basically flat to down 10%. So there definitely is a precedent for gold having long periods of outperformance, but gold's going to do what it's going to do, and gold can definitely trend. And I would say it doesn't really matter why it's outperforming. It's just the objective reality that it can and does and currently is outperforming.
Yeah, I think I look back on that. I look at it and I say, okay, there's two types of gold investors. There's the ones who have been invested in it steadily over, like Nate, you were saying, the rolling 10 years. And if you're one of those people that's been holding it for 10 years, you've underperformed by 2.6% the equity markets, right? If you're somebody who has been in it recently and not a long-term investor in it, and you're trading in and out of it, my perspective on that is, you're guessing, and you have to be right with the guess, because the thing about the difference between gold and stocks is that gold has no earnings. Okay. Companies make and sell things, and they have earnings per share and profits. And you are buying stocks to have access to those earnings and hopefully the growth in those earnings over time. Gold doesn't do anything except sit. It is literally controlled only by supply and demand. And there's just no way to forecast supply and demand accurately and effectively and efficiently as an investor. So you've got to guess and you've got to be right. And I think that's really hard to do. So just some perspective on gold. I think if you feel like gold is something you have to have in your portfolio, my advice on what to do is, please do not buy the physical gold and have these gold bars in your safe or something like that. It's the most inefficient way to buy gold, because buying gold, the physical gold, is easy. Try selling it. And all you have to do is go watch the episode of that new show out, Black Rabbit, now on Netflix. Like when you have jewelry or something and you go into a store that buys it, they're going to buy it for a massive discount. It's like Rolexes or anything else. Like you're just not going to sell gold for what it's trading for in the spot market if you walk into a store or a gold precious metal trader and try to sell it. They're going to give you a massive discount on the price. And the other thing too is if you're holding it because you think the world's going to come to the end, like I don't know what you're going to do with a gold bar. It's not like you're going to be out in your backyard smelting it down into coins that are more transferable. I mean, you've got a gold bar that's worth $1,000. How are you going to make change on that if you need to fill up your car with gas? So I just don't think it's a really efficient way to invest in gold is to own the physical gold itself. And back to stocks. I mean, the thing about stocks is you know what you're buying in terms of earnings, and you just look at the PE ratio. Everybody throws the PE ratio out. But I'm just going to put some context in the PE ratio. Basically, the PE ratio is telling you how many dollars you need to spend to buy something that will give you $1 of earnings. So if the PE ratio is 25, you are spending $25 to get that $1 of earnings. So as the PE ratio goes up, you're spending more and more money to have access to that same dollar of earnings. But you can at least make some sort of forecast on how well a company is going to do and make a decision that you're going to buy something at that PE ratio, at that expense level, let's call it. With gold, you can't because there's just no earnings. So it's very difficult. So make sure you are being purposeful in your purchase of gold and you're buying it in a way that is efficient and effective to trade. And I'll just kind of close out my gold thought with that, and we'll jump into question number 3, which is, and I alluded to this before, so everybody kind of knows my answer already, but I'm going to pose it out to Nate and Erin here, which is, are we currently in a bull market, and how long can the equity market continue to rise, and are we due for a pullback? And parens, without knowing who asked that question, I know exactly who asked that question. So anyway, Erin, go ahead and why don't you kick off with that answer?
Yes, we are objectively in a bull market. And here are some statistics to throw out here. And then anecdotally and intuitively, this should make sense as well. I'm going to read off some notes here, so forgive me for looking off screen. Here recently, the S&P 500, which everyone knows, the Russell 2000 small cap stocks, the NASDAQ composite, so not just the NASDAQ 100, and the Dow Jones Industrials, all made new all-time highs within a week of each other. This is a good thing. In technical analysis, this is called the principle of confirmation, when you get multiple indices confirming each other's moves. In the prior 8 instances of this happening since 1982, the median return for the S&P 500 over the next 12 months has been 17%. So yes, we are in a bull market. Markets are making all-time highs. It's not just S&P. It's not just NASDAQ. We've got small caps joining the party now. And when this happens, historically, it's been a good forward-looking indicator for stocks.
Yeah, I think short answer is I don't have a really different one. Yeah, we're in a bull market. I mean, if you look at the S&P returns, I know, Dave, you gave the average 12-month return going back to, I think, the mid-70s. We'll stretch that back to the 1928, I'm sorry. That's 97 years. The average is 12%, let's call it. Well, as you said, year to date, we are well above that. So we have had strong markets, and that's on the heels of 2 years of very good market environments in 2023 and 2024, where the S&P 500 was up 25% in each of those years, not over the 2-year period, 25% and 25%. So really what you're looking at is a very strong market that's trending above average. And, if you look at the current 10-year average, so over the past 10 years, markets are averaging about 14% a year. So we're currently right at that year to date through the end of the quarter is about 14-ish%. So we've had a strong average-like year. But what I think that means is we might be due for a little bit of volatility coming up. And the reason being is, Dave, I know you talked about a lot of the industries had a very strong Q3. And, looking at the New York Stock Exchange, so all the stocks in the NYSE that are listed there, at one point in September, 90% of those were setting new all-time highs. So to Erin's point, we saw a broad swath of the market setting new all-time highs. However, though, in the past couple of days moving it back, that number's now come down to 74%. So that's still a very high number. This isn't me saying that all momentum is out of the market and run for the hills, but it is showing that there is kind of, been some profit taking or some just maybe a little bit of a pullback in a small way. But a pullback doesn't mean 20% down, bear market, the world's on fire. The market goes through these kind of swings. As we all know, we experienced one earlier this year. On average, the market, experiences 5% declines more than once a year. So you always need to kind of be aware that when you're at all-time highs, pullbacks are possible. Dave, to your point right at the beginning of the podcast, the advice of maybe wait to raise cash if you can for tax reasons. But if you know you're going to need that cash, taxes be damned. Don't let the tax tail wag the investment dog. So if you can wait, great. There's a lot of benefits from a tax planning scenario. But if you need the cash, you are seeing markets hitting really all-time highs, which is not a bad thing at all.
Thank you both for that. I'm going to use that as an opportunity to transition into final thoughts, because I do want the three of us to kind of riff on any final thoughts. And what I'll do is I'll use, Nate, I'll use your point, and Erin, your point as a transition into my final thought, which is this. Nate, you started to touch on it. I'm going to punctuate it a little bit. Look, I can tell you with as much as I'm allowed to say 100% assurity for compliance reasons, I can't, right? I'm joking around a little bit. But look, there will be a 5% pullback. There will be a 10%, a 15%, a 20, a 30, maybe even a 40. There will be. What we and what no one else can tell you is when that is going to happen. So as an investor, you have to be intentional in your investing strategy. And this goes back to look, if you like to have gold in your portfolio, make sure it is an intentional investment into your portfolio, and not because you're at the bar last night and your buddy's like, I'm up 40% on my gold trade. I'll guarantee you, he may be up or she may be up 40% on their gold trade this year, but I'll bet you in the net, it's nowhere close to being that much of a profit. Okay, so be intentional with all of your investments. That is a huge component to it. And then if you are intentional about it, be intentional about having cash. 12 to 18 months of your cash needs is a great planning figure. It could be less than that. I don't know if it should be that much more than that, but what that cash allows you to do is now when the market, like earlier this year, pulls back 20% you don't have to do anything because your cash needs are covered. In my mind, that is an alternative investment, right? That is a way to lower volatility in your portfolio. If you didn't have to sell in March of 2025 to raise cash for the vacation you were going to take in the summer that you knew a year ago you were going to take, you didn't care that the market was down 20%. And now we're back to where we are. And I just think that is a great way to be intentional with your strategies. I'm also going to riff for a second on inflation and dividends and income, because one of the things that we say really routinely around here to clients and generally anybody we talk to is make sure that you're not holding a melting ice cube. And dividend stocks are a great example of that. So if you have a dividend stock, you're basically owning two opportunities to make money. You're owning the opportunity to have a consistent dividend paid out to you in cash for owning that security, and the opportunity for price return. And those two things together are total return. Some people own dividend stocks and just say, all I want to do is capture the income on that. Be very careful with that perspective in a vacuum, because now you have to weigh it against inflation. So if you have a dividend paying stock that never moves in price and the dividend yield doesn't change and the dividend payout doesn't change, you are eroding those cash dollars by the rate of inflation. So you need to make sure, if you're a dividend investor, that you're looking at a couple different things. One, what is the opportunity to get a dividend? And then two, what has been the historical trend of that company raising their dividends on an annual basis? True or false, that dividend increase over X amount of time has tended to outpace the rate of inflation. You've got to be looking at those two things, because if you hold a dividend stock that doesn't move much in price and doesn't do a great job of increasing its dividend on an annual basis at a rate that exceeds inflation, You are holding a melting ice cube, no matter how good it feels to see that cash hitting your account. So that's my final thought, guys, for this episode on inflation dividends. Nate, why don't you go ahead and riff a little bit on what your final thoughts are, and then Erin, if you've got any, jump in after Nate.
Yeah, Dave, I think that's a really key important point, because we look at client portfolios, and I'll speak specifically to client portfolios that are maybe not in accumulation mode, but in distribution mode, cash flow generating portfolios, and dividend stocks come up frequently in that. They're a piece of it. But the other piece too can be interest rates. Interest you've earned on cash over the past couple of years has been pretty high. Bond interest rates have been pretty high. Well, guess what? The Fed cutting rates means those rates are going to likely come down. So no longer are you going to be able to generate forever the interest that you have been able to from, let's say, non-risk assets. And bonds have risk, cash has risk, everything has risk, especially when it comes to inflation. So what that means is that if you're going to be looking for ways to continue the income stream, it's going to be about that second piece, I think, Dave, that you mentioned, the price return, because stocks are one of the greatest hedges against inflation when you look at financial assets. So you're going to have to be relying on that total return approach. You might not be able to generate all the income you need from that interest piece or dividend piece. You're going to need that price appreciation. And it's managing the two over time, which is very difficult, I would say, for portfolios in distribution mode. But that's what we do for our, investors, for everyone that we try and get this podcast to, is make sure you're balancing that total return and looking at a sustainable withdrawal rate from your overall portfolio. So your withdrawal rate might be, let's just say 6%. If you can generate 3% of that from income, well, that means your price return, you really only need 3% to make a net out for the year. Now, hopefully you get more than 3% price growth, but this is the kind of calculus you're going to have to be doing. And the math is changing. So speaking to being intentional, you're going to have to be very intentional with your asset allocations going forward if the Fed continues to lower rates. So it's a double-edged sword. People are excited for lower rates because it means lower debt, lower mortgages. It's easier to take on and sustain those. But for anyone who's trying to create a cash generating portfolio, again, those rates are coming down. The math is going to change a little bit. You got to be ready for that.
Yeah, I'm looking. Okay, so this topic comes up all the time, Nate. I'm sorry, Erin, I'm going to jump in real quick and I'm going to toss over to you. But this topic comes up all the time when we talk about the monument dividend strategy, which is a strategy that holds 20 stocks and they pay a dividend. And sometimes people will say, well, why do you hold stock XYZ? And I'm not going to say the actual stock, so I'm just going to call it ABC, but this is an actual stock that I'm talking about. Why do you own stock ABC when it only has a 2% yield on it? Okay. And I say, well, because year to date, you got a 2% dividend yield. Okay, great. The stock has historically increased its dividend over time. Great. But 2% isn't that great of a yield. Why do I want to own one of my 20 stocks that has a yield that's less than, say, the S&P 500 over? Well, because that stock's up 20% year to date. And so if you did need some cash and we had to harvest some of that 20% gain on top of the 2% yield, you'd be paying long-term capital gains rates on that and not ordinary income. So make sure that you understand this concept of total return if you're a dividend investor, because you've got to look at both of those things together. You just can't look at yield in a vacuum. So everybody's probably ready for me to shut up on this topic. So Erin, I'll toss it over to you to close us out here on any final thoughts.
I want to go back to the alternatives bullet point, and specifically private equity. So private equity is marketed to investors these days as having some combination of higher returns, lower volatility, and correlation benefits. And I just want to remind people and go through a brief thought exercise that if you're thinking about private equity, these are some things to consider. So first thing is on the returns. I do not doubt that there are private equity managers that have the ability to generate outsized returns. And if you invest in one of these funds and look back in 10 years, you may have killed it versus something like the S&P or the NASDAQ. However, the opposite is also true. And when historically you look at these active private equity managers, if you look at the dispersion of returns over the top performing and bottom performing managers, here's a term that an old boss used to use, that difference is big enough to drive a truck through. So it's not a very small dispersion. The best performing managers do outperform by a lot, but then you've got really poor performing managers, and good luck determining that ahead of time. So manager selection there, as they say, is very crucial. As it pertains to volatility, these are also lauded as having lower volatility than public stocks. And on the surface, of course, we know that's probably true. But also keep in mind that private equity vehicles aren't required to quote unquote mark their portfolios every single day or every single second, like you see in the public stock market. So ask yourself if the stocks, and that's what they are, they're privately held, but if these stocks and private equity portfolios were put on the open market and you ask the market to evaluate them on a tick by tick basis, do you really think you're going to be getting lower returns there? I think you know what the answer is. And so that's why I go back to saying that the lower volatility aspect of private equity investing is often a contrived metric. Which brings me to my final and probably the most important point as we talk about alternative investments. And this is where I make the distinction between diversifying alternative investments and non-diversifying alternative investments. When you look at a quote unquote diversifier, what does that mean? What are you looking to diversify? You're looking to diversify what they call the systematic risk of stocks. And what happens? Why do stocks go down? Well, stocks go down because the market is always trying to evaluate and price future cash flows. Well, if the economy goes south, future cash flows are going to take a hit. If interest rates go up, well, those future cash flows are going to get discounted back to the present at a higher rate, and it's going to make them smaller. And that combination can hurt stocks. But it's basically what's happening in the broader economy, both with growth and interest rates. So I would ask somebody who's thinking about private equity as a quote unquote diversifying alternative investment, are these companies, these stocks that these private fund managers will be investing in, do they operate in some different otherworldly economy than the stocks and companies in the public stock markets? The answer there is no, they do not. And this brings me back to my point, which is private equity is lauded as an alternative investment, but I think it's important to make the distinction between diversifying alternative investments and non-diversifying alternative investments. And it's that second bucket where private equity resides.
Yeah. And I'll just close out by saying, like, I rightfully maybe get the reputation as the guy that hates private equity. And I do, but, you know, asterisk, I don't hate private equity or private investments because I hate them. I hate them when they are purchased or sold to investors for the wrong reason. I hate it when they get sold as the silver bullet or the shiny thing or the thing that you have to have, and then investors buy them without really understanding all the pitfalls. So if you're an investor and you've got the money set aside for an allocation into a private investment and you understand all of the fees specifically, right? Because in my analogy, that's the, you know, drinks coming whether you like it or not, can't really get out, have to pay the big cover, all that. Like, and if the club's really hopping, they tack the 20% on top. Like, if you get all that, great. If you understand that 3 days before you're about to file your tax extension on October 15th, that you may get an updated K1 and you're okay with that, I mean, that's great. As long as investors get into it with eyes wide open about liquidity, fees, pain in the ass factor, all of that stuff, they're fine. It's when people buy them just because they heard about them or somebody has got a motivation for selling them or something like that. That's when I start to get a little twisted up about it. But if anybody has any questions or thoughts on that, just, you know, reach back out to us. But I'm going to use that as a way to wrap up our quarterly markets insight, which is we like to call Ask Monument Anything. Erin, Nate, thanks as always for your thoughts. It's always fun bantering with you two, and I enjoyed it. It's one of my favorite times of the year. So now, as a reminder, if you have any specific questions you want to hear answered here on the pod, you can submit those questions by emailing any of us directly if you have our email address, or you can use a special email address that we have set up, which is offthewall@monumentwm.com. So again, off the wall, all one word, offthewall@monumentwm.com. And in case you haven't done so, make sure you go to our website and subscribe to our newsletter. That's how you get access to our monthly version of this, the monthly version of Ask Me Anything. They are exclusively on our private invite-only YouTube playlist. And to get on that, you've got to be subscribed to the newsletter, because that's how we let you know what the link is to listen to the monthly Ask Me Anything. It's just a more condensed version of this sort of banter going on. So just simply, and if you didn't write that down because you're driving or something, just go to monumentwealthmanagement.com/subscribe, or just go to our website and search around for the subscribe button. It's all pretty obvious on there. So with that, just a reminder, hey, we and Monument specifically, we're here to help you tackle life's biggest decisions. And we help you tackle those decisions with confidence. And we want to help you make life option rich. So if you or someone you care about could use our help, tell them to go check out our website and poke around on there. You can read about our philosophy. And if they think that we're what they're looking for, great. They can reach out to us there. They can get hooked up with our newsletter and watch some other videos that feature other members of the Monument Wealth Management team as well. It's kind of a cool way to get to know somebody without having to have, a committed conversation. You just get an idea of what everybody's personality is like and what it's like to meet with us. So, okay, with that, remember, this is just a personal favor. I'm just asking everybody here. If you like this pod, if you're like, hey, that was pretty good, can you just quick go over on your phone and just scroll down a little bit and give it a 5-star review on Apple or Spotify? Leave a comment. That really helps a lot. It takes like 3 or 5 seconds. And the benefit to us is it just helps the podcast pick up some traction on Apple or Spotify on the streaming players. With that, take care, and we all look forward to connecting with you again on the next episode of Off the Wall.
The previous presentation by Monument Capital Management LLC was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Different types of investments involve varying degrees of risk. It should not be assumed that the future performance of any specific investment or investment strategy or any non-investment related planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Monument's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Monument is engaged or continues to be engaged to provide investment advice services. Monument is neither a law firm nor an accounting firm. No portion of its services should be construed as legal or accounting advice. No portion of the video content will be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Monument is engaged or continues to be engaged to provide investment advisory services. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request at www.monumentwealthmanagement.com.